only mode.
Good afternoon. Welcome to FIIG Securities webinar this afternoon, Getting Serious Insuring Against Inflation. My name's Elizabeth Moran. I'm Director of Education and Fixed Income Research, and today I'm host. The presenters today are Dr. Stephen Nash, Director of Strategy and Market Development, and Gavin Madson, Director of Infrastructure and Fixed Income Research. Now, before I start, I'll just run through a few housekeeping tips. On the right-hand side of your screen, you should see an orange arrow. If you can't see that orange arrow, just click on it and it should expand. So a little way down the list, you'll see there's some questions and an opportunity to ask questions. And if you'd like to ask any during the presentation, please type them in. Okay, now I've just a note's come up on my screen that some participants can't view the webcams. I'm hoping that you can all view the webcams. Please be patient with us. We'll just check that that fault. Okay, so today's agenda. First of all, we'll have Dr. Stephen Nash talking about what is inflation and why it is important. Then the history of Australian inflation, followed by forecast inflation, including risks to the forecast. Then he'll look at ways to combat inflation and which is most effective. And finally, give a description of the different types of inflation-linked bonds available. Gavin Madson will then come on and discuss different ILBs that are available and have a bit of a relative value discussion. Now I'd like to introduce Dr. Stephen Nash. Stephen's had a number of years with FIIG. He also has a long list of qualifications, including a doctorate in economics from Cambridge University, and has over 20 years experience in funds management along with inflation-linked bonds. So I'll hand across to you now, Stephen. Thanks.
Thanks very much, Liz. I just really wanted to start by defining what we're talking about in terms of what inflation is. And as the first slide shows, we try to define inflation in line with what the Australian Bureau of Statistics does. And inflation generally measures the purchasing power of money, or how far your money goes in terms of purchasing a basket of goods and services. When you save, you defer spending so that you can enjoy at a later point in time. So inflation really remains a key risk to your investments over time. High inflation erodes the value of saving. Even moderate levels of inflation can, over time, really erode the value of your savings. Even 2.5% inflation over 10 years has an important impact on your total savings. So just looking at the history of Australian inflation on the next slide, we notice that the inflation rate is, the annual inflation rate is defined by the blue line on the left-hand axis of that chart. You can see that inflation started in the 3 to 5% range and then peaked in 1974 around 17%, has moderated dramatically, particularly in the period after the 1990s where the RBA has been controlling inflation in the 2 to 3% band. On the right-hand side, on the blue line, we've got the recent moves in the oil price and also the RBA commodity price index in Australian dollars. You'll notice how the oil price has moved quite significantly of late. Also, commodity prices have edged up quite significantly. Generally, we're expecting inflation to be well contained in the 2 to 3% band, but there are risks to that outlook, and on the next slide we'll go into a few more details on those risks. So the main scenario does remain for fairly contained inflation. Again, we've got on the left-hand side inflation with the dark blue line. Again, we've got the oil price with the light blue line on the right-hand axis. But we're considering one of the major risks to be at the moment risk from a Middle East conflict and quite elevated levels of oil prices towards the $150 level or possibly over that. Our central scenario is for inflation to remain in that band, but I think in terms of risks and managing portfolios and also portfolio allocation, it's very important to have coverage of inflation, and I think the oil price remains a key risk for inflation going forward.
So Stephen, just to clarify, if oil price spikes, has a potential to spike, that's that purple line, that the spike above there, and the green, the blue and the orange line are our three forecasts, with the blue middle line in that oval, that's our expected inflation.
Yes, that's right, Liz. The middle line there in terms of the ringed area is our central forecast, but I think that rise in the oil price is something that people have really got to consider in detail. If the oil price was to rise dramatically, the RBA would have very limited options, and I imagine that they would tighten monetary policy. But over time, as that oil price fed into transport of goods and services, we would have a general rise in price levels and possibly also a rise in wage levels. And that would severely impact the performance of investment portfolios, and inflation would eat into those portfolios and reduce purchasing power over time.
Okay, thanks a lot, Stephen.
So the next slide, we're looking at the risks of the forecast. There are downside risks. I think at this point we imagine that growth will remain quite low, particularly due to European austerity measures and fiscal drag in the US. That should moderate wage claims and keep inflation fairly contained at this point. Also, the termination of the carbon price by the coalition government towards the end of the year should lead to moderation in Australian inflation, as we saw an uptick in inflation as a result of the carbon price late last year. The upside risks really centre on the concerns that Israel have with regard to Iran's emerging nuclear capability. We did quite a detailed piece last week on those risks, and we thought that the Obama trip recently to Israel really highlights the concern that the US has at the moment with regard to Israel, and we imagine that the United States is trying to stop Israel from being or becoming any more aggressive with regard to Iran at this point. They'd be particularly concerned about the possible impact of a conflict on the oil price and then the knock-on effect onto US economic growth. The other upside risk a lot of other people have highlighted is quantitative easing in many of the developed economies, which could over time lead to inflation in developed economies. But I think the most pressing risk at the moment is from the oil price, and I think the Obama trip really highlights those risks right now. Next week,
Stephen.
Yeah.
Oh, sorry, we've just got a couple of questions. One from David, and he's just wondering what you think the impact of American gas coming on stream will be, and whether that will take some of the heat out of a possible spike in the oil price. He did wonder too about governments inflating their way out of their indebted positions, which I think you've talked about. Really, you're saying with quantitative easing there, in other words, flooding the market with money may lead to inflation, which you've raised. But maybe if you could just comment on the American gas coming on stream, and also Ross and John have commented about the US shale oil expectations.
Okay, thanks, Liz. With regard to US gas production, I think that's quite an exciting development in the US. Promises over time to reduce the dependence of the US on foreign oil, but again, that's over time. We have a pressing issue right now with regard to the Israeli concerns about Iran, also with regard to the deteriorating situation in Syria and the possible use of chemical weapons either in Syria or against Israel by the enemies of Israel. There's a lot of weapon transfer going on at this point, and that's another problem that's really concerning the Israelis. So yes, I think over time that the shale oil will be important for the US, but I think that self-reliance based on growing oil shale reserves is something that's going to be a factor in the medium term, and I think we've still got an ongoing reliance by the US at this point on foreign oil. With regard to governments inflating their way out of debt problems, yes, this has been highlighted by a lot of investors. Recently I was at a portfolio construction forum conference, and this was repeatedly brought up as a topic. I think, yes, that is a medium-term threat, and I imagine that that could influence inflation in the medium term in more about the 3 to 5 year point of time, but there's always a risk that inflation comes earlier, and that's another reason I think why you've really got to focus on inflation in your portfolio and think seriously about what forms of insurance you've got against rising inflation. So Liz, will we go on to the next slide?
Yep, we should have that. Stephen, can you see it now?
Yep. Okay. The main ways to combat inflation, firstly, equities are used typically as a way to grow out of problems with inflation, and the advantage of equities is that they help you participate in the growth of the economy, and they really perform well when expectations are strong. But the disadvantage, of course, is that volatility of expectations drive equity prices and really don't have much to do with inflation. Gold is seen by some as a store of value, particularly with regard to weakness in major currencies, and it does remain a stable source of value. But again, the demand and supply for gold has very little to do with Australian inflation. House prices are one hedge against inflation, and they are an important aspect of the CPI, but the disadvantage is that housing has a limited representation in the CPI. Commodities are also thought as a hedge against Australian inflation, but again, they really only provide part of the coverage in the CPI. There's a lot of services that are covered within the CPI. So that brings us to inflation-linked bonds, or ILBs as we call them, and we describe those as the only asset class that provides a reliable relationship to inflation. And a possible concern there is that there may be a requirement for liquidity, and as one requires more liquidity, it tends to distort that relationship to inflation. But basically, inflation-linked bonds pay a return stream that is directly linked to inflation. So all these asset classes have separate roles to play within the portfolio, and inflation-linked bonds play the role of insurance against inflation. So I think that's a very strong aspect of inflation-linked bonds that people need to consider. Okay, on this next slide, it's a little bit busy, I'm sorry about that, but we've got quite a bit of data here, and what we're trying to do is look at rolling 5-year correlations to Australian inflation of the various asset classes. With the data that we had available, we would have liked to have much longer data sets, but that's the maximum that we could find. There's been no selection of data here. They're all the maximum data sets that we could find at this point. Now the top one there, as the box indicates, at 100% is the inflation-linked bond correlation to Australian inflation. Obviously these bonds, if there's no liquidity required, between purchase price and maturity will give you 100% correlation to Australian inflation.
Sorry, Stephen, just for the listeners out there that don't know what or haven't studied statistics, maybe you could just explain what the correlation means.
Yeah. Sorry about that. The correlation generally refers to the way two time series move together or move in different ways. If two time series tend to move together, they tend to have what they call a positive correlation, and we show that above the 0 point on that left-hand axis there. Something towards 100% is seen as a very strong correlation. Anything over 20% is typically seen as reasonably significant. And if two time series tend to move in opposite directions, that has what we call a negative correlation, and we can see that some asset classes have a quite strong negative correlation with inflation. Now, that brings us to the purple line in this chart, where we see equities having quite a low, almost negative correlation with Australian inflation, and that's really the opposite of what most people expect. That they've been told repeatedly that equities will provide coverage for Australian inflation, and in fact the opposite is the case over many years. Up the top there we can see the orange line, which is what we've represented as an average between inflation-linked bond, credit inflation-linked bond correlations between the 100% line, which is where no liquidity is required, and the sort of aqua line there, where daily liquidity is required. You can see that there is a fairly strong correlation there, one that really needs to be taken into account. I think that given that strong correlation, it's something that investors need to take on board and build into their portfolio asset allocations. We can take this analysis a little bit further on the next slide, where we look at the risk and return.
Stephen, can I just interject there? I've got a couple of questions on liquidity. On the previous slide, and I'll just quickly take us back there, the disadvantage for ILBs. Brian's asked the requirement for liquidity may impinge on relationship to inflation. He's just wondering if you might expand on that a little.
Yeah, look, it's a situation where if you require daily liquidity on the inflation-linked bonds, what we call the mark-to-market impact of that liquidity will tend to distort the relationship that the inflation-linked bonds have to Australian inflation. So in the sense that you purchase the security and you don't trade the security, you will get that 100% correlation we were talking about before. But if you need to trade the security regularly, that will tend to distort that relationship. So what we're trying to, I suppose, emphasize is that it's really important to think about these things from a long-term perspective, and to ensure that you're not trading these things on a regular basis, so that you have them as a cornerstone for the portfolio, which provides long-term insurance against inflation. And we have further on some of the things that tend to drive those mark-to-market variations, and we'll go through those in a minute or so.
Okay, so just before we move on to the slide after this one, we're back to the insurance against inflation. I have John and Jerome asking if you can explain the difference between constant liquidity and partial liquidity, but I think you've covered that really in the previous slide. Unless you want to expand on that further, Stephen?
What we're talking about is constant liquidity means that you'd be looking at daily mark-to-markets and accessing liquidity on a very regular basis, whereas partial liquidity would be where you would be only looking to trade the security every once in a while, possibly once a year or once every 2 years.
Okay, let's move on.
Okay, so we're on to the chart that looks at the risk and return relative to the Australian CPI. And what I've done here is got all the various data and calculated all the return, which is on the relative to CPI on the vertical axis there, relative to CPI. So we can see we go in terms of return right up to around 8% above inflation for Australian equities. And on the horizontal axis we've got risk. So that's the annual risk relative to inflation. So what we're trying to do with this graph is show how the various asset classes are related in a risk and return sense, which you're probably quite familiar with regard to these sort of graphs with equities and other instruments with regard to the Australian CPI. And you can see that equities have a quite a good return characteristic relative to inflation, but they have associated risk is very high relative to inflation. You can see that that risk in equities is between 15 and 20% a year. It's very, very large. Gold's even worse, up towards the 25% level. The CRB there is just the commodity price index. Again, the return aspect's not that promising there, but the risk again is quite large. Now, I think the interesting aspects here are, the credit ILB liquidity on maturity, or point A there, the red dot. What we're saying there, if credit ILB of a solid investment grade credit was purchased and there wasn't any requirement for liquidity until maturity, the risk to inflation is zero, because that security will track the Australian inflation 100%. The only variable is really where you purchase the security relative to the Australian CPI. If you purchase the security around the 4% level, as we're estimating there, you can see that's quite a good return relative to inflation. And we've recently done some more work on longer-term relationships of equities to inflation in the US. And since 1950, the average annual return of equities relative to inflation is around 4.5% level. So 4 to 5% is roughly an equity return, but in the case of the credit IRB, you're in a much more superior place in the capital structure. You're in a senior unsecured position typically relative to an equity where you're at the bottom of the capital structure and face a lot of variation in terms of capital price day to day, and also upon liquidation you're in a much worse position than the credit IRB. In the middle there we've got what we're calculating is the average or a midpoint between daily mark-to-markets, which is the point B there, or the blue point with the arrow towards it. So for most investors, I imagine that they'll be looking for some sort of liquidity between purchase price and maturity, but not ongoing daily liquidity. So we think that tends to emphasize the risk and return of credit IRBs relative to the CPI, and you can see that credit IRBs come out very well on that sort of analysis. Now, further to those questions we just got, we do have on the next slide factors that tend to change the price of inflation.
Actually, Stephen, before we move on, we've got quite a few questions. I've got questions. Exactly what does CRB stand for? I know it's a commodity index, but can you explain, do you know what the CRB stands for there?
It's an acronym for Commodity Research Bureau Index. So that's just in order to get the point on the chart. I've just used CRB as a way to summarize that commodity index risk and return relative to the Australian CPI.
And also we have a question about CRILB. That means a credit inflation-linked bond. So credit inflation-linked bond is like a corporate issuing an inflation-linked bond as opposed to a government. So a government where there's no credit risk as such compared to a corporate issuing an ILB. A couple of other questions. How do we measure risk for the purposes of this chart? Do you want to take that one, Stephen?
Yeah, it's a good question. We get the daily data from the various data sources that we have, and we generate a standard deviation relative to the Australian CPI. So we look at the annual annual returns on a daily basis for each of these asset classes relative to the CPI, and then generate a standard deviation relative to the Australian CPI. So it gives you an idea in terms of, at most times, how that asset class is going to, or how far it could deviate from the Australian CPI at any point in time.
So really risk is volatility, so how volatile as the asset class is. So I'm hoping that answers most of the questions. I've got a couple here. We can always talk to you offline if we haven't answered them. I just would remind clients today that this is an inflation-focused seminar, so if you have any questions outside that inflation theme, we'll certainly answer them, but we'll get back to you offline.
Okay, I think we're back.
Yes, we are. Sorry. Yes, we're back, and I've just moved on to the next slide, Stephen. So over to you.
Thanks. Now, factors that can change the price of inflation-linked bonds, like most securities, inflation-linked bonds are affected by perceptions. One of the most important drivers of inflation-linked bond pricing is perceptions of inflation, and the higher the expectation of inflation is, typically the higher the yield will be for the inflation-linked bond as participants in the market become concerned about increases in inflation. But that's probably not of that much concern to you, the ordinary investor, who really has an inflation-linked bond to protect against inflation. So it really doesn't matter what happens with inflation. Once this security is purchased, say at a 4% real yield, if inflation went to 10%, the investor would receive 10% plus that 4% in addition, so that would be 14% for that particular annual period. So that is why people should really look at these securities. It does provide a lot of insurance directly against inflation. Another thing that affects the price of inflation-linked bonds is just demand and supply of the underlying securities, which varies from time to time. Perceptions of monetary policy, tightenings and easings tends to affect the price of these securities. Central bank inflation target changes. We saw one recently with the Japanese changing their inflation target upwards. Also perceptions of a change in the creditworthiness of an issuer, and Gavin will cover off in detail that. I think that's quite an important point. It's really important that you cover off the credit side of these securities before purchase, and we do a lot of research into that, and Gavin will cover that off soon. And also perceptions in changes in underlying economic growth will tend to affect the price of these RLBs. But I think one of the most important points there is the creditworthiness aspect, and we will cover that in Gavin's part of the presentation. So could we maybe flick on to the next slide there? Now, inflation-linked bonds come in two main formats. The first is the capital index bond, and this is the most popular format for issuers globally, where the issuer has an obligation to the bondholder which rises with inflation. Here the variations in inflation during the life of the bond are added and subtracted to the capital price of the bond, which results in what we call is the adjusted capital price. And the adjusted capital price is really the critical part that you have to understand with regard to capital index bonds, and it's not that hard. We'll go through a simple example now. If we had a 3-year capital index bond with a 4% coupon rate, and we had inflation at 3% per year, then the adjusted capital price would rise from $100 at the start or the issuance point to $103 at the end of year 1. Then in year 2 the adjusted capital price would rise again, $103 plus the 3% on the $103, which would be $106.09 at the end of year 2, and then $109.27 at the end of year 3. Now this means that the issuer has to pay you as the bondholder not $100 as was the issue price, but $109.27 at maturity. So the So the issuer's exposure to you as a bondholder increases, and that means your principal is completely protected against inflation for the life of the security. Now, the coupons of the interest payments are also based on this new adjusted capital price. So typically a bond pays on a capital price of 100, but these bonds rise with inflation. So as we mentioned there, the adjusted capital price goes from 100 to 103, and to 106.09, and then to 109.27. So that 4% coupon we mentioned at the start gets multiplied by that increase in capital price over time. So at the end of the 3 years, your 4% is multiplied by 1.0927 and comes out at roughly 4.37 at the end of year 3. So that means your principal and your interest are fully insured against inflation over the life of the security.
Stephen, we've had some questions about CPI, which we've omitted, and I think that's an error on our part, so I apologise. Let's just run through briefly what the CPI and how it's measured. I had a question earlier on regarding petrol's not reflected in the CPI, but perhaps you'd want to comment on that and what exactly is in the CPI for the listeners.
Okay, the Australian CPI has 11 groups in it. It's designed to cover the majority of purchases in what they call a Consumer Price Index population group, which covers a wide variety of the Australian population. Things like food and non-alcoholic beverages are covered, alcoholic beverages are covered, clothing and footwear, housing, furniture, health, transport, communication, recreation, education and insurance. So it's quite a wide variety of things that are covered. I imagine that in the transport part that the impact of the petrol price does come through, but obviously there's other impacts of petrol prices on all the other groups within the CPI, as there's a lot of transport required to deliver these items, and so that's how the oil price sort of feeds into the CPI.
I think it's interesting, one of the things I looked at not so long ago was one of the things that feed into CPI are people's travel, and they actually take into account the cost of a family holiday to Bali and to Fiji, which I think, great, what about an Australian holiday? You know, nice to be able to afford those overseas holidays. But I guess too, in that way, if you're looking at the cost of a holiday to Fiji or Bali, there'd be the factoring in the price of the ticket, which would in some way factor in the price of oil. There's a couple of other questions. Again, we'll if we don't get to your question today or through the session, we'll certainly contact you after the session. I've had a note that some questions are coming through to our client services email inbox. If you'd like us to address the question in the presentation today, you actually need to type it on your screen in that panel on the right hand side. So if you haven't clicked on the orange arrow, click on the orange arrow, the panel will expand, and about halfway down you'll see a question area. So you can just type those questions in and we'll endeavour to answer them on the way through.
Yeah, there's a lot of questions about the CPI, you know, particularly with regard to changes in the quality of goods over time, and there's been a lot of literature on, you know, how do you put in a standard computer when the quality of the computer increases over time, and they typically treat these changes in terms of what they call hedonic adjustment, and that we get that adjustment in the Australian CPI, but each of the calculators of the CPI across the different countries have different approaches, so it's not a uniform approach globally in terms of how the CPI is calculated. Each country has their own approach, and a lot of people criticise the CPI for not representing their basket of goods and services, and I think it's very difficult for the ABS to cater to everyone's needs, but statistically that's the best we could come up with at the moment. The problem, of course, with the CPI in the Australian situation is that it is only a quarterly release. The RBA has tried to get a monthly release going, but with the current spending cuts, it's not been approved. But hopefully, we can get that monthly release over time.
It's interesting, Stephen, I just have a quick comment from Tom, who said that he recalls Keating taking out Sydney property rentals to get a better CPI number way back. I guess they must have gone through sharp rises at some point, but I guess also Sydney house prices aren't necessarily, or rental prices aren't necessarily reflective of the rest of Australia. So would you like to move on to the next slide?
I'd like to. That'd be great. Thanks.
Okay.
Okay. So the next slide is the graphs. Now the graphs relate to our previous slide where we went through that simple example of a CIB, 3-year maturity, 4% coupon with inflation at 3% per year. Now you can see on the left-hand side we've got the adjusted capital price, and on the right-hand side we go through what happens to the coupon. So just looking at the left-hand side, at issue, the bond was priced at $100, so you pay the issuer $100, and at that point, the issuer has the liability to pay you back $100. Now, as inflation proceeds during the first year, and it went at 3% for the first year, we can see the adjusted capital price goes from $100 to $103, so the liability of the issuer to the investor has gone up from $100 to $103, and that just continues through the life of the bond, up and up towards year 3, where we get $109.27 that the issuer needs to pay back to the investor. So looking at the right-hand side, what we've done there is look at the coupon, where we had a 4% coupon at the start, and then we multiply that coupon by that adjusted capital price as it goes up from 100. So in the first case, 100 times 100%, or 1 times 4% is obviously 4%, but as we get 103 times 4%, we get 4.12, and then the rest calculate out to those various coupon levels. So you can see that principal is indexed to inflation, and also the coupon goes up with inflation as well. So it's a very complete and effective way of insuring against inflation in our view. That is the capital index bond. I think the next type we're going to do is annuity.
Sorry, Stephen, just had a quick question from Karen. What about capital price and return when inflation decreases?
Okay, when we have deflation, these bonds can go down. Well, they will go down in price. So, for example, if we had inflation for the first year at 100, we went to 103, and we had 3% deflation in year 2, the adjusted capital price would go down from 103 back to 100 for that at the end of year 2. Typically, these bonds have a base of 100 so that they can't go through that. I think in those sort of situations in a deflationary environment, what would happen with the secondary yield on these particular securities would probably drop substantially, as growth would be so low that investors would be reaching out for any form of yield, and you'd probably have a decent capital gain on this bond. But yes, the deflationary aspects do come through on the capital index bond, which is a bit of a form of a contrast to the next type of bond we're going to look at, where that typically doesn't happen with the indexed annuity. Typically the indexation only applies to increases in inflation and not to decreases in inflation. So that's something to be aware of. The deflationary environment's not a very pretty one, wouldn't be very pretty for other investments at all. So having a look at the indexed annuity bond, just we've got a bit of a detailed slide there. It's really just a simple, it's something that you'd probably be very familiar with, and that's a mortgage payment. It's very similar to a mortgage payment, which is a combination of principal and interest. Think of yourself as a bank, and think of the issuer paying you back a mortgage payment. And that mortgage payment is typically constant over the life of the loan. And if we had no inflation, that mortgage payment or base payment would remain the same throughout the entire life of the bond. We think that's quite unlikely, of course, and this is the reason we're purchasing the securities, is that we want that base payment to move with inflation. So typically, as inflation goes up, there's a index ratio that's applied to that mortgage payment, which makes the mortgage payment rise with inflation. So the indexed annuity is a very simple form of an indexed linked bond, and it really is just a flat payment which is indexed to inflation. Well, I've got a simple example here. There's quite a lot of mathematics involved in this, but really it's a pretty simple idea. And if we looked at an indexed annuity bond with a $100,000 face value and had 3 years until maturity, and we had zero inflation with an interest cost of 2%, then the flat base payment on that annuity would be about $8,606.64. At the end of that 3-year period, you would have all your principal paid back, and you would receive a little over $3,000 in interest as the principal balance falls during the life of the indexed annuity. So basically, you're getting a little bit of principal back each time at each quarterly payment. So the principal outstanding is only for about, well, the weighted average principal outstanding is only 1.5 years, because you get a little bit of principal back at each quarterly payment. Now assuming the same indexed annuity bond as above has constant 3% inflation over the 3-year period, that base payment will now rise to $9,381.24, or the base payment we specified at $8,600 times 109 at the end of year 3. So each quarter the base payment goes up a little bit, or 0.0075, or 3% divided by 4. So the first base payment at the end of the first quarter is multiplied by a factor of 1.0075, and then that continues on and on until the end of the life of the security. At the end of the 3 years, the base payment is multiplied by 109, or 3 years inflation at 3%. So I think that's all very well in terms of a written explanation. I think the chart on the next page really shows what that means. Now on this slide, the dark blue bars are that flat base payment which doesn't change. If we had zero inflation, that would be the return on the indexed annuity bond. So it's completely unchanged, a little bit of principal, a little bit of interest each quarter, 12 quarters, 3 years. And the light blue line is where that flat payment is indexed to a constant 3% inflation. So you can see that the base payment increases gradually over time as we have a constant 3% inflation over that 3-year period. And it looks like you're making a lot of money out of the indexed annuity bond, but really all you're doing by having that indexation there is keeping the purchasing power of that money constant over a 3-year period. It's really got nothing to do with increasing the value of the money. It's really keeping the value constant with regard to inflation over the 3-year period, something that I think will become more important over time, particularly if we have any of the risk scenarios that we were talking about earlier, increasing inflation over time. So I think that chart really shows you what the indexed annuity bond does. Quite a simple structure, basically a flat payment stream multiplied by a increase in the CPI over time. So very simple. I think a lot of people are very familiar, or probably too familiar, with the idea of a mortgage payment. This is basically the same thing with an inflation indexation on top. And I think we can show the contrast between the two cash flows here in the next chart, where the dark blue series of bars is the capital index bond. You can see that the payments during the life of the bond are quite small, and the indexation goes into the principal, and there's a very large principal payment at the end. So the cash effectively gets trapped into the capital index bond over time and is not paid out until the end, Whereas the annuity, you can see the light blue bars there, you're getting a much more consistent payment stream over time. You're getting access to principal over time, and they're really different different approaches to the same problem. One is where the principal is withheld within the instrument for a longer period of time, providing less reinvestment risk, whereas the indexed annuity is one where investors have access over time to their own principal and face a little bit more reinvestment risk over time. Just summarising those two on the next slide. I think the advantages of the capital index bond is that the principal interests are completely linked to movements in inflation. It should be a cornerstone of a lot of investment portfolios. Inflation is a central risk to investment. If you don't cover inflation, you don't think about it carefully, you could easily get caught out, and equities really don't provide adequate coverage, although you've probably been told the opposite by many financial advisors and others over time. Capital index bond traps the principal in the structure for a longer period of time. One of the risks of the capital index bond is that your exposure as an investor to the issuer grows over time. So you need to understand the credit that you've got, and you need to monitor it carefully, and that's what FIIG does in detail, and I think Gavin will go over that again a little bit later.
Okay, Stephen, I've got some questions. If you finish with that slide, is that you good to?
Just on the index annuity bonds, I think, we've said this before, but I think the index annuity may suit retirees a little bit better because they can access the capital without having to trade the bond over time. The problem with the IAB, of course, is that there may be some reinvestment risk for investors. That's basically it. Thanks, Liz.
Okay, leads nicely to a question that we have from Dan. How do we reconcile inflation risk with issuer risk? That is, as the capital increases, the issuer has to repay you at the end of the term.
Oh, okay. Typically, the issuers of inflation-linked securities have underlying CPI-linked cash flows. For example, a operator of an airport would have in the lease agreements CPI linked terms and conditions so that the underlying tenant has to pay increases in the CPI. So basically the issuers of these securities pass on those cash flows to investors. So the issuer is not taking on extra risk by, typically not taking on extra risk by passing on those cash flows to investors. So they're typically related to the underlying cash flow of the business at hand, and the issuer is basically passing on the benefits of those cash flows to investors.
Okay, sorry, I'm just reading the questions here, and there's lots of them, so I'm sure that I'm going to miss some, but that was good, that was good. So that should also answer a question I think we had earlier from David about which institution, why institutions issue CIBs, and that's because they have that the cash flows linked to inflation as well. Daryl's asked about timing and purchasing in relation to the time in the cycle. How important is that? You know, is there a question of that, Stephen?
Sorry, Liz, could you just repeat that one? Sorry.
Yeah, so he's asking how important it is in terms of timing, in terms of purchase your ILBs. Is that an important consideration or not so important?
Look, I think the timing's pretty important at this point because we think some of these securities are quite inexpensive at the moment. The real yields are quite attractive. What's going to happen, and as more people realise the value of these securities, those real yields will decline. Prices of the underlying bonds will go up because there's limited supply out there. A lot of these securities were issued prior to the financial crisis. They remain sound investment grade credits. There's a limited supply, and the demand as education increases, I think will increase as well. So that will mean that the availability of these securities will decline and the real yield will drop. So you're better off buying a security at 4% over inflation than 2% over inflation.
Okay, thanks, Stephen. A couple of questions here. One from Karen, just wanting to confirm, in a deflating environment, can the price go below 100? In most instances, it's in the prospectus that the value of the ILB cannot go below $100. Christina's asked, where do CIBs rank in the event of insolvency? Most of them are issued as senior debt, so they rank highly in the capital structure. Again, that would be something you'd have to check with the individual investment. And David asks, with inflation, BBSW would generally rise, and why are bonds linked to BBSW not adequate protection against inflation? Maybe, Stephen, you want to answer that one?
Thanks, Liz. Yeah, that's a question we typically get. It's a good question. Yes, if we did get a rise in inflation, yes, the RBA would tighten monetary policy, but the RBA also have to be aware of trying to maximise employment. So there may be a situation where the RBA has tightened but can't tighten as much as it probably would like to reduce inflation, or the underlying causes of inflation, for example, a very high oil price, are something that's really beyond their control anyway. So by tightening further, they really wouldn't be able to wipe out or reduce inflation substantially. So the costs of tightening would be greater than the benefits, and therefore the RBA wouldn't tighten, so that you could be in a situation where, yes, you will get higher, some higher returns from your floating rate note, but the problem will be, of course, that your underlying principal is not completely indexed to inflation. So these securities really come to the fore when you get particularly unexpectedly high inflation, where that increase in inflation is really not captured in market pricing, and you get the full benefit of the inflation protection in these securities, whereas you'd miss part of it by investing in floating rate notes.
Okay, thanks, Stephen. Just a couple of quick questions from John before we move on to Gavin. And he's asking, how do you compare the return between a CIB and an IAB?
How do you compare the returns? Well, we typically look at these securities in terms of a real return relative to inflation. So we look at the modified duration of both of the modified duration is another technical jargon term we love to use in the fixed income universe, and all that really means is the weighted average cash flow of the individual securities. So we line up all the individual modified durations, and we look at all the real yields as well. So we compare them on a term or modified duration basis and real yield basis. So modified duration helps us to compare different securities, IABs versus CIBs. So it's really the length of the cash flow that we're looking at, and once we have that length and we can see what the market offer is in terms of the real yield, then we can compare different securities across the yield curve. So we effectively create a yield curve from short to very long, and then we look at real yields across that curve. Okay.
There's a couple of other questions, but I think we'll move on at this point. It's getting on with the time, I've just noticed. So I'd like to take the opportunity to introduce you to Gavin Madson, who's been with FIIG for, I think, about 3 years now. Gavin has spent 12 years as an infrastructure and energy asset analyst, half of which was focused on fixed income. So he brings lots of experience to the role, and I'll hand over to you, Gavin.
Thanks, Liz. I think Stephen's made the point that if what you're looking to achieve with your investments is protection against inflation, then ILBs are definitely the way to go. So I'll briefly talk about some of the ILBs. Once you've made that decision, where do we see the value? And the first two I'll look at, and these are the CIBs, the bonds that are increasing in value. There'll be names that are familiar to most of our investors, and they are Sydney Airport and Vestra. We already had a question from Liz about where do these rank. Both of these bonds are ranked senior secured, which means they are the top ranking in the credit structure. So if anything happens, basically the bondholders take control of the assets and look after themselves, which is I always find a good thing. So the ILBs, I think the question may have specifically been talking about ILBs compared to other bonds, and the senior bonds would all be ranking the same. So the ILBs and the fixed and floating senior bonds for Sydney Airport and for Investor would all rank the same, and you'd be as I said, first in the line in any wind-up. As I mentioned, a lot of listeners might be familiar with these names. They've heard them before from me and seen them in our research. And the reason why is because when I first started here 3 years ago, Sydney Airport was the best value ILB in the market, and I think that's still the case. As Stephen also noted, at some point the rest of the market's going to catch on and the price is going to increase. But at currently, Sydney Airport remains probably the best value in the market, and one of my preferred bonds. It's actually probably one of the best value bonds, full stop, in the market currently, not just an ILB. And as we go on to the next slide, also we see some highlights of what we see in Investra. And the thing with both of these bonds is they are senior secured, which we like. They both have stable cash flows, which are regulated by the relevant regulator, which is another thing we like, and they have a diversity of income. They're not tied to a single customer that could walk away and leave you in trouble. These bonds are both run by the bonds are controlled by companies which are well managed and well run. And the spreads on offer more than compensate for what's out there as far as risk concerns are for these businesses. We actually do look at a lot of other bonds in the market. It's just that these two are the best value. So we don't bother. I guess as an analyst, I don't bother wasting my time on bonds that I don't think are great value. So these two have maintained great value, and that's why we concentrate on them the most. And I guess go with the depth and quality of coverage. And I guess the choice between the two of them, it's probably more to do with the individual investors' appetite for length of investment. The Sydney Airport offers a 2020 and a 2030 maturity, and the Investor has a 2025 maturity. So depending on where you sit in those time frames for how as an investing horizon, basically I'd be picking the one that suits your horizon best. And you'll actually see that the pricing, if you speak to your dealer at FIIG and ask them for the pricing of those three bonds, you'll basically see that they price according to maturity. The shortest bond offers the lowest return, the longest bond offers the highest return, as you would expect, as you look for a return on of length of investment. As we go to the next slide.
Gavin, before we go on to the next slide, I just want to ask a couple of questions. On behalf of Jonathan, he's wondering what the Sydney Airport ILB's current yield to maturity is. So I know that you suggested that they call their dealers, but I believe the 2020s, it's CPI plus about 3.9%. Is that right? Do you know offhand?
I believe so, but as an analyst, I tend to stay clear of the noise that is pricing. But yeah, I believe 3.9 for the 2020 is correct. And
the 2030s, I think, is closer to 4.5. But again, we're analysts, so not looking at pricing on a daily basis. So don't hold us to that. But it's thereabouts. So it's CPI. So you earn whatever inflation is plus that margin. So, for example, CPI last year was 2.4%. So it would be for the 2030 bond, it would be 2.4% plus the 4.5, giving you about 6.9%. So very good returns from senior debt debt and the low risk bond, and as Dr. Nash mentioned earlier, much like an equity return but senior debt, so a big difference in the risk there. A couple of other questions in terms of who issues the bonds. We'll go on to that in a bit more detail as the presentation progresses. I just want to make the comment that Investor is actually my favourite bond. I like the fact that it's wrapped compared to Sydney Airport, which actually means it's much lower risk. And I'll just ask you to comment on that, Gavin, please.
Yeah, the credit wrapper that sits over the top of Investor, a credit wrapper for those listening who probably aren't familiar with the term, is basically a bond insurer, and these companies, which have existed for over recent years, have when a bond issuer, so in this case Investor, wants to issue a bond, but they want to pay a lower fee, they get what's called a credit wrapper or an insurer to ensure that they will make the repayments, and for return of that they pay the insurer a fee, and the insurer lends its credit rating effectively, which means if you're at a higher credit rating, you pay less on your debt. So they'll do a calculation of whether the cost of insurance is more than the discount they get on their debt, and if it is, hey, they'll go ahead and effectively buy the insurance from the credit wrapper. Now, heading into the GFC, some of these credit wrappers were insuring businesses they probably shouldn't have insured, and they went broke, and most of them have fallen by the wayside, but the one that remains on Investor is the one that has actual value in the market, a company called Assured Guarantee, and it maintains a high credit rating where the others have fallen by the wayside. So yeah, I guess so that adds a value over the top of Investor as far as lowering the risk, but it's because of what's happened with the other credit wrappers, the rest of the financial market to a large extent doesn't place much value on the credit wrapper. However, we at FIIG believe that that Assured Guarantee credit wrap still provides value to investors, and it's for free basically. As we go on the next slide, as I said, the Investor and the Sydney Airport are the two that we like the most, but there's many other out there, and many other ILBs out there that we look at, and they come from Commonwealth government, state government, big four banks, Rabo, which is a large international bank, and there's also other infrastructure assets, including most of the other airports in Australia, capital city airports in Australia, will have an ILB at some level in their debt structure. So there are other bonds out there. These Investor and Sydney Airport just happen to be, I guess, my two favourites on a relative value basis. But if you don't like either of those two names, we're a bond broker. We'll find something else that you might like. If there's something else you're interested in, if you're thinking about an ILB from a bank, which sometimes show good value, and happy to take the lower return on offer, we're happy to look for those for you and I guess do some research for you. And then move on to the IABs, which are the home loan style, I guess for want of a better description, ILBs that Stephen was talking about, because of the fact that they pay back the principal over a period, like as a home loan, they generally get issued by issuers that have a finite life. So in particular, what we've seen largely in this space is that they're issued by public-private partnerships, and in particular ones providing social infrastructure, so schools, universities, hospitals tend to be the larger issuers of the IABs. And up on this page, we've got a number of the issues, a number of the projects that issues related to these which are available. And I guess pricing moves around, but currently, I guess the best value that we see here is the Australian National University and New South Wales Schools IABs. Now they're both longer. They've both got longer investment horizons out around the 2030 period. For those with a shorter investment horizon, we look at we like Praco's IAB, which is the Department of Defence headquarters, down there on the left-hand column. So for those looking at a short horizon, our recommendation would be Praco. For those looking for to lock in a longer cash flow, either New South Wales or Australian National University. The ANU IAB offers a slightly lower yield because it's got a higher credit rating and therefore lower risk. But it's probably one of the outstanding values. So if you're not chasing quite as much yield, it's what we consider a very low risk IAB. New South Wales schools, I have no concerns about that either, but it offers a slightly higher yield because the credit rating reflects that it's being paid by the New South Wales government rather than the Commonwealth government. And if we move on finally to the last slide, which is just I guess just a sample portfolio, and here you see we've included the Investra and Southern Cross Airports Corporations, which is Sydney Airports, the 20 and 30. We've also included the New South Wales Schools and ANU IABs and the Praco for the short dated to help boost, and we just included Nova Care there as well, which is a Newcastle Hospital project IAB. So I guess that's just to give you an idea of you can build a portfolio looking at nothing at IRBs or put this within a part of a larger portfolio or cherry pick what sort of suits you, and I guess that's an individual discussion for investors to have with their dealer about what sort of time frames they're looking for. And you can see there the yield to maturities that are coming up in that in the YTM column, which gives you an idea of the sort of returns that are on offer. Obviously, the higher returns in the Investor and Sydney Airports reflect that they are slightly lower credit ratings than the IABs, and also reflects that as an IAB you're getting your principal pay down over time, so your risk decreases over time, your exposure to the credit decreases over time, and that's reflected in the yield to maturities there. Liz, I guess we'll time to start going to questions and answers.
Thanks, Gavin. I'm typing furiously there to a couple of questions. Had one pre the webinar today, which is always great for us because it gives us a little bit of time to consider them, from Bob. And there's a number of other questions as well regarding to asset allocation and how much should investors allocate to inflation-linked bonds. But perhaps I'll just ask Stephen to talk very generally about asset allocation, and then I'll ask Bob specific questions after that. So I'll hand over to you, Stephen, just to talk generally about asset allocation to bonds, and perhaps the split between the CIBs and the IABs.
Thanks, Liz. I think generally with regard to asset allocation, we take a fairly conservative approach, and that is people should generally own their age in bonds. Now what that means is if you were 50 years old, you probably should have around 50% bonds, which you'll probably say, oh, that's way too high compared to what I've heard from others in the financial community. But we think that's appropriate because as you get older, your ability to recover from a difficult period in the equity market effectively reduces. Fixed income provides a lot more certainty of income. Also, you have the ability to allocate more to inflation-linked securities and basically ensure that inflation doesn't affect your savings pool, particularly in the pay-down part of your retirement. And inflation can really wreak havoc if it's not adequately insured against, and I think as you approach your retirement, your basket of goods will change and it will become much more related to the more essential items in the CPI, and variations in food prices and fuel prices will really start to affect you a lot more than they did during your accumulation phase. So I think if you're 30 years old, we're recommending 30% bonds, possibly up to 70% equity, so that's quite an aggressive growth stance there. But as you get older, you've really got to back off that risk taking and try to ensure that your cash flows are adequate to meet your needs in the pay down section of your retirement planning. We probably advocate more CIB exposure to younger investors who have a longer time horizon and don't really need to draw down on their retirement savings. The IABs are more suited to retirees. It's also possible to combine CIBs and IABs together in one cash flow. We have the ability to do that now on our dealers now the ability to show investors what combinations of CIBs and IABs will look like. Now, you might say, so what? What does that really mean? Well, the CIB, as we mentioned before, has a really big payment at the end, whereas the IABs have payments through the life of the bond. And if you combine them together, you can really neutralize the impact of the large payment at the end from the CIB, so that you get a much more even and consistent cash flow, really tailored to what you will need going forward. And if you're really worried about reinvestment risk, if you're worried about real rates dropping, which they probably will given the demand we're seeing out there for these securities, you probably prefer the longer security. A lot of this really depends on what your propensity or willingness to assume reinvestment risk is. So for those who are more conservative and don't really want to take on a lot of reinvestment risk, the CIB or where the money is trapped in the security for a longer period of time is probably the more appropriate format for you. Those that really need to access the capital over time, the IAB is really the format for you. Is that okay, Liz?
I think that's good, Stephen, really good. I've got a question here from Karen, who just wants to know, and we've got the last slide up there, the difference between the face value and the capital value. Perhaps, Gavin, you might answer that, because we also have a question from Jeff wanting to know why the Preco ILB capital value is below the face value. So I'll hand over to you to answer that, Gavin.
Liz, that might be. I'll do that on offline. I think it's a technical description, so it might be easy to do it via an email.
Okay. Well, I'll answer the capital value, face value question. So the face value is actually the value of the investment at the moment, and the capital value is what you would pay for the investment. So the investor, if that matured tomorrow, the company would owe you $123,910. But if you wanted to buy that investment today, that capital value is $114,647. There would be some accrued interest on top of that as well, because with bonds, when you purchase bonds, you pay the seller the accrued interest they would have earned between the two interest payments. So I hope that makes sense, Karen. I have a question from John, and he's wanting to know what's the maximum percentage of a portfolio that you would invest in Sydney Airports and Investra. Perhaps, Stephen, you might answer that one.
Okay, Liz, I think what we generally try to recommend is that people try to get as much diversity as they can in their portfolios. Although we really like Sydney Airport and Investra, we recommend that investors try to take on as much diversity as possible. So that ILB recommendation list there includes a few other names. We would recommend that investors try to seek as much diversity as possible. So, given that you're in a quite a secure position with the Sydney Airport security, and it's a very solid investment grade credit, and that you're in a senior position, you could probably have or a lot less diversity in that portfolio relative to an ordinary equity, where we'd obviously need a lot of diversity to offset the possible risks involved. given that the risk is a lot lower in the security, it is feasible for you to take on a larger percentages in terms of asset allocation to individual securities, possibly up to around 10 to 20% in one individual security or issuer.
Okay, I think there's still a few questions that we haven't gotten to, but looking at the time, it's we've been going for a while now, and I know many of you will have appointments to attend. So we will conclude our presentation this afternoon, but please, if you have any questions, you can still type them in the next minute or so to us, or alternatively just use our info@FIIG email address. I should point out there's a lot of information on our website about inflation-linked bonds. Dr. Stephen Nash writes regularly for The Wire on inflation-linked bonds, and we do have a dedicated inflation-linked bond page at the moment. We also just putting the final touches on our updated Australian Guide to Fixed Income, which we hope to publish in the next 3 months or so, which will have a new dedicated chapter to inflation-linked bonds. So there are a lot of resources available to you. Of course, you can always speak to any one of us, email any one of us, or one of our sales staff are available to help if you're wanting a quote on any of the bonds. So I would like to thank you all for attending today. I hope you found it useful and you've learnt something, and please don't hesitate to call us if you need any other information. Thank you very much for attending. This concludes the seminar. Good afternoon.